This Honest Money podcast is brought to you by Prescient Investment Management, informed by science, guided by insight. Prescient Investment Management is a registered financial service provider.
Hi Warren and team. I would like to know what advice you can give for pensioners, particularly how much should be in equities. Would the calculation of 100 less your age be a good equity allocation and the rest in bond? Also, what percentage of equity allocation should be in foreign investments, assuming a large portion of bonds could be in local investments? Furthermore, the current volatile markets highlight the need to not have all my income in a living annuity, but invest in a guaranteed annuity. Given the current high CPI, would it be best to wait for markets to improve and hopefully the CPI to decrease before moving my money into a guaranteed annuity? Fortunately, my current drawdown is between 4% and 4.25% and could ride it out for the rest of the year before making a decision. Thanks, Avram.
Thanks, Abram. I think it's a very difficult and pretty complex answer to your question. So maybe just to let's kind of take a step back and let's talk about some of the phrases and almost the jargon that we've got to clarify here. So we've got living annuities, and for most of us, when we retire, we're going to put our money into a living annuity, and what that means is it's an income generating investment that is, we're able to draw at least 2.5% a year from the investment up to a maximum of 17.5% of the capital that's invested in there. And I think it's important to know that when you put your money in, it is your money. So if you decide to draw 17.5% and stock market growth for the next 10 years or 50 years is only 10% a year, and you're drawing 17.5%, you need to know that you are going to destroy the value of your money. You're actually going to erode it to zero. So the fact that it is a retirement vehicle and it'll pay an income doesn't mean that it's absolutely safe. It's your decisions, how you invest that money and how much you draw, that will determine whether that investment will do well for you over your lifetime. So living annuities are really good. I love living annuities. I think low cost living annuities that are well constructed, where investors draw a relatively low percentage are the ideal investment vehicle. The problem is that they get some bad press sometimes, living annuities, because people start by drawing very high percentages, 10, 12, or even the maximum. And then when their money runs out, they complain that this was a lousy investment. And the reason for that is simple education. People aren't educated correctly about what the dangers are of a living annuity. And like any good financial tool, it's not perfect, and certainly the advantages could also be disadvantages if used incorrectly. So the other offering that you can take advantage of would then be a guaranteed annuity. And that is simply a contract between you as an individual and an insurance company that you say to them, here's my money, all of my retirement money, I'm going to give it to you, and what income stream are you going to guarantee me for the rest of my life? Now, it sounds like a really attractive proposition, because then you don't have to worry about stock markets going up or down. You can just sit back and get your income on a monthly basis. And especially for people who don't like investing and don't like markets and don't like the volatility of seeing investment values shoot up and then fall over, a guaranteed annuity sounds really attractive. And I think there is a place for guaranteed annuities. They're especially valuable for people who simply don't have enough money when they retire. So if you're retiring and you look at a living annuity calculation that says, you're going to have to start drawing 10% of your pension on a monthly basis, or on a yearly basis, I should say, just to kind of meet your living costs, then it might be worth looking at a guaranteed annuity, because it might not pay you the 10% on day one. Let's say they only end up paying you 7%, but it's going to be a high income for most of your life. The downside is you are not guaranteed that the income that they pay you will track inflation every year for your lifetime. They'll try, and they certainly will try to match inflation with the income that they provide you, but it's not a guarantee. So guaranteed annuities, you get a false sense of security because you get this money, and then it's a high level of income on the first year of using a guaranteed annuity, but it's important to know that by year 5 or year 8 or year 15, the buying power of your money might be less. If the markets haven't done well, that is what the insurance companies will use to generate the inflation growth. So low market returns mean that they won't necessarily be able to give you a high level of income growth every single year. So again, the security of a guaranteed annuity is only really valuable in the early days. Later on, it does introduce a different kind of risk to you, and that's inflation risk. So if someone is retired and has an income stream of 4 or 4.5% a year from a living annuity, in other words, they don't have to draw a huge amount from the living annuity, and they've got sufficient assets, I like a living annuity. I would prefer that, Abram, to answer your question, over a guaranteed annuity, and I wouldn't worry about CPI and what's going on with the inflation environment. I would simply stay with the living annuity I've got and make sure that it is low cost and well structured. I'll explain that now, but I think the important thing there is, if you've got a living annuity and it's in a high cost place, let's say you're at a company that's charging you a massive fee, you are able to move a living annuity from one company to another. There's no restriction that forces you to stay there. Whereas when you've got a guaranteed annuity, you're stuck for life. The moment you sign a contract for a guaranteed annuity, that's a contract for the rest of your lifetime. That's how it's going to work. You won't be able to get out of that. I know that from bitter experience where we've tried to transfer clients living guaranteed annuities from companies in the past, and it's simply not possible. So Abram, in terms of your question around how much should you have in shares, if you want to beat inflation and get the best combination of capital growth with some risk, but not too much risk, I think you need an allocation to shares that ranges from around 65% to 75% over your lifetime. So I'm not a big fan of saying take 100, subtract your age, and that's the allocation to shares that you should have. So for example, if you're 90 years old, saying that take 100, subtract my age, which is 90, I should have 10% in shares, and that's how I go. That rule of thumb is a rule of thumb only when you don't know much more about your investment position. So for example, if you're 90 years old, but you're worth 100 million rand, you could have everything in shares, because actually you're probably going to leave that money to the next generation. And so worrying about your equity allocation in that situation is not a good idea at all. Whereas if you're 58 years old and you've retired and you're drawing a relatively large amount from your living annuity, then actually you can't afford to take too much risk with your shares. So with shares. So that means that you probably need a lower allocation to shares just to try and get some inflation protection, and you need a higher allocation to bonds and cash, so that you get a high level of income and then a little bit of the exposure to shares to get you the inflation protection. So I think you've got to be careful there about these rules of thumb. In terms of allocation to overseas investments within your living annuity, the law has changed recently to allow balanced funds or all unit trust companies to increase the offshore allocation to around 45% of retirement funds, and I think that's probably the right allocation. I think that's over the long period of time, depending on where you want to live and all of the other things, but 45% is a good benchmark, and then that's for offshore, and then share allocation of 65 to 75% for most people will be right for most conditions. I can't make it more specific than that. I wish you all the best. I'm not sure I would go the guaranteed annuity when you're drawing 4 or 4.5% a year. So perhaps avoid that for your own position.
Hey, I just wanted to find out. So I've recently opened an easy equity account, and I've seen that it goes up by like 20 Rand and then decreases by like 20 Rand or goes into negative. I just wanted to find out, how does it work versus like opening a savings account and getting your monthly interest? As I know, with a savings account, you get like an X% per annum. How does it work? How do you grow your money using easy equity? Should you take your shares out at a certain point? Like when things are going high, you then take them out and then rebuy when they're low, or how exactly does it work? Can you just leave your money in there and it will automatically grow? Or do you actually have to sit there working at it? I hope that makes sense. Thanks so much.
Thank you for your brilliant question. I think it's something that a lot of people grapple with. When they look at opening an investment account for the first time, and they start putting their money in there every month, they just watch this account going up and then it goes down. And especially in very volatile, rocky markets, which is probably most of the time, it's very disconcerting to see your account going down, sometimes for weeks or months in a row. And then when you look at your savings account or your fixed deposit, you only ever see it going up. So I think it's important to understand the difference. A savings account or a fixed deposit will go up every single day and every single month, and it gives you a huge sense of comfort that your money is always going in the right direction. It's always going up. The problem is that money is only growing at a rate that probably matches inflation. And so, your cost of living and actually the buying power of your money is not going to grow at all by putting your money in a savings account. There will be times when it feels great because, stock markets are going down and everyone else is losing money and your savings account is going up. But I think it's important to understand the context here. Your buying power is not being protected. And so even though you're getting a sense of security from your money going up every day, it's a false sense of security. You're actually, your 100 Rand that you've got today won't buy you what it can in 5 years' time if you only ever add interest to that money. So unfortunately, you're going to have to embrace the idea of uncertainty, the idea of volatility of markets. And that means you need to buy investments that are going to ride like a roller coaster. They're going to go up in good times. They're going to go down in bad times. But the idea there is that over the next 5 and 10 and 15 years, the investments will grow much faster than what a savings account will. And certainly there'll be months or even a year or two where the investments won't do as well as a savings account will. And then you can send me a voice note and to complain about that, and let's talk about it again. But what I do think is important here is you need to have investments that are going to grow faster than the inflation rates, making sure that you protect the value of your capital in real terms to protect the buying power of your money. And so for me, that means you need exposure to the stock market. The best way to get that, if you're starting out and you're saving with small amounts of money, anything from 50 Rand to a few thousand Rand at a time, is to buy an index, to buy something that gives you exposure to global stock markets and South African stock markets without you having to become an expert on individual shares. So if you've got an investment account and it's invested in a broad range of shares or in an index, then by all means, buy the investment and, don't worry about looking at your account every day or every month. You certainly will never be able to get it right to buy when things are low and sell when they're high and then buy when they're low again. And that's not a comment about you or your level of expertise. It's just simply not possible to do in the real world with real money. With all the professional money managers in the world that have been doing this for the last nearly 150, 200 years, they have not been able to buy low and sell high on a consistent basis. There will be the odd time when they get it right, and actually that's a fluke. And then they get huge, kudos in the press because they're investment geniuses. But it's just really funny how those investment geniuses, when the next big market shakeup happens, just disappear because actually they were just lucky once. And unfortunately, you can't be lucky all the time. I wish we could. So I think if you've got an account, an investment account, it doesn't matter what the platform is. Make sure it's low cost. Make sure that you've got a broad range of investments, and then keep going. And if you're interested in the stock market, you could also, for example, look at a unit trust that's a general equity fund or a global general equity fund. You don't have to just be in an index. I think I always talk about indexes, but the unit trust market is equally compelling as long as the fund that you're in is low cost and well managed and extremely well diversified. I think that's a key point in the investment thesis, is you've got to control your costs and then be sure that you're getting value for the fees that you are paying. I hope that helps, and I wish you all the best on your investment journey.
Prescient Investment Management. Informed by science, guided by insight. Prescient Investment Management is a registered financial service provider.